Not every deal is a good deal. Last month, we looked at a company trying to raise $4 million, and on paper, it looked very interesting. But after digging into it, we said no, and here's why and what you can learn from it. Let me paint the picture. This was a company that was in the commodity trading world. They wanted asset-backed lending. They were trying to raise $4 million for a 6-month bridge loan. Their security was $10 million worth of gemstones held in escrow, and the return was about 15% annualized. On the surface, sounds interesting, high return, short duration, collateralized, but when we dug in, we found something else. Red flag number one, there was no operating business. This wasn't a company with revenue and customers and even a product. It was purely a financial speculation play. They were betting on gemstone value going up. And if they were right, they'd flip the collateral and pay back the investors. But if they were wrong, then you're left with the gemstones that you can't liquidate. Why this matters is that Wellington Capital, we don't just do completely commodity placements. We finance operating businesses with real cash flow. If you're not generating income through operation and through a product, and if you're just betting on asset price appreciation, then that's not a business. That's simply gambling. And we're not in the gambling business. Red flag number two, illiquid collateral. They said the deal was secured by $10 million worth of gemstones, but here's the problem. Gemstone valuation is very subjective. You can get completely different quotes from completely different people worth completely different values. And if the deal goes south, then how do you actually liquidate the gemstones? You can't just sell them at open market. You need specialized buyers, you need auction houses, certification. It takes time and ultimately eats into your recovery. Now compare that to real estate, something you can sell, rent out, or even foreclose. Or equipment, something you can lease or sell. Something like accounts receivable that you can factor or at least wait for payment. Those are real assets with liquid markets. Gemstones, not so much. Red flag number three was that the founder couldn't even answer basic questions. We asked simple things like, what's your operating model if gemstones don't go up in appreciation? How do you generate cash flow to repay investors if you can't sell your collateral? What's your track record with similar deals? The answers were vague, lots of hand waving, no concrete plan, and that's when we knew that this wasn't for us. Red flag number four is simply that it didn't fit our model. We specialize in growth companies with positive EBITDA, infrastructure and real estate projects with contracted cash flow. Think M&A advisory for companies with actual operating history. This deal didn't fit any of those criteria. Could it have made money? Yeah, maybe, but it wasn't our domain expertise. And when you're outside your expertise, that's when you make expensive mistakes. So what got us to actually say no? It really comes down to three principles that we use to evaluate every deal. Number one is we finance operating businesses, not speculation plays. If you're not generating cash flow through operations, we're not interested. We're not betting on commodity prices increasing. We're financing companies that make money by solving problems for customers. Principle number two is that the collateral must be liquid and defensible. If we can't quickly liquidate the collateral in a downside scenario, it's not a real security. We want assets with established markets like real estate, equipment, or even receivables. And the last principle is simply stay in your lane. We know what we're good at. We know the kinds of deals that we're looking for and that we can actually execute. When a deal falls outside of that scope, we simply pass, even if it looks attractive. Now, what can you learn from this? Lesson number one is that not all capital is good capital. Just because someone is willing to write you a check doesn't mean that you should take it. If the deal structure is speculative, if the collateral is questionable, if the business model doesn't generate operating cash flow, you should probably walk away. Lesson two is understand what advisors and investors are looking for. We at Wellington Capital are looking for operating businesses with real revenue. We're looking for defensible collateral with liquid markets. We're looking for clear cash flow generation within the business. and we're looking for experienced management within the team. If your deal doesn't check these boxes, you're going to struggle with raising institutional capital. And that's a sign that you need to rethink your structure, or at least wait until you have more traction. And the last and third lesson is know your lane. Don't take deals just because they're available. Take deals that fit your expertise and investment thesis. We're great at financing growth companies, infrastructure, real estate. We're not commodity people. So stay in your lane, do what you do well, and simply say no to everything else. Look, I get it. If you're just starting to do deals, it's hard to say no to them, especially if you're just building that deal flow. But the best firms aren't the ones that do the most deals. They're the ones that do the deals right and they actually get them across the line. So if you're raising capital and you want to know if your deal is structured right, simply reach out. You can find me at wellingtonrow.com or on LinkedIn. Simply search my name, Nick Milani. Remember, be disciplined, stay focused, and raise right.